Hey, Roger here, signing out of the BFN. And man, oh man, what a crazy week of trading. Today, we're going to be talking and breaking down and explaining a little bit of how that crazy, uncertain movement happened with GameStop and all the players involved. And more importantly, what does that mean and what kind of opportunities does that create? So stay tuned, because if you're not watching, you're definitely not winning. And what you need to do is subscribe, like, and comment, because it's about to go down. Hey, good day, good evening, good afternoon. This is Roger Chowdhury, signing in here at the Business Financial Network. And here at BFN, I'm sure, along with the rest of the world, we're pretty surprised about what's happened with GameStop. What happened here? A lot of people believe when they're trading securities that they're trading securities that represent an ownership stake in the underlying businesses, and over long term reflect the fundamentals of those businesses. But as you can see here, those two can become very disconnected, and there's nothing fundamental about these moves. There's nothing technical analysis will be able to tell you. This was basically a move that was based around mechanics. And, to further, explain those mechanics, let's check it out right here, okay? So this is a really good thread I found on Twitter by Sahil Bloom. And the story of the week in finance is how a group of retail traders at WallStreetBets, with the assists from Elon Musk and Chatmath, took down the establishment of short sellers at GameStop. A thread on the underlying mechanics of GME saga. First, for all those unfamiliar with the business, GameStop is a video game and merchandise retailer. It has less than 5,000 stores, primarily in malls across North America, Europe, and Australia. The business has struggled to modernize, hurting its financial and stock performance. Number two, for a variety of business reasons, a bull, i.e. optimistic case regarding its future performance has formed. It really came to the forefront after RC Ventures, an entity managed by Chewey, the founder, Ryan Cohen, disclosed a large position and assumed 3 board seats. Number 3, Ryan Cohen summarized his case stating, "We are excited to bring our customer-obsessed mindset and technology experience to GameStop and its strategic assets, expanding the ways in which it delights customers and by becoming the ultimate destination for gamers." Number 4, at the time of that statement on January 11th, GME stock was trading at about $20 per share. Since then, the stock has surged to $200 per share and captured the public imagination. But how did it happen? There are two dynamics at play here, a short squeeze and a gamma squeeze. By the way, guys, this today GME stock topped out, I believe, at 370, 380. Number 5, first the short squeeze. This occurs when a short seller or short sellers, those betting against a stock like Melvin Capital here, are forced to buy the stock to exit and cover their shorts. Basically, he wrote another breakdown on a short squeeze. You guys can look that up yourselves. It's a pretty simple function of someone using margin to sell a stock they believe has more potential for bearish or downward sentiment. Number 6, the gamma squeeze is a bit more complicated. As usual, let's simplify it here for everyone to understand. A gamma squeeze is all about options contracts and their indirect impact on the underlying stock. So again, you guys should look up options. Huge space right now for traders that are millennials, and it's a really important thing for you guys to get into if you understand the way that short squeezes work and the way gamma squeezes work. 7, when you buy a call option on GME, someone has to sell you that option contract. You pay them you pay them, sorry about that. You pay them a bit of money, the premium, and they make a commitment to deliver you the underlying stock at a future date for the strike price of the option. It's a pretty simple transaction. But in the background, the seller, often called a market maker, has to think about their risk exposure. If GME rises above your strike price, they will have to buy the stock at the market price and sell it to you for the stock price, incurring a potentially large loss. Number 9, to hedge this risk, when the market maker sells you the option, she also goes into the market and buys a bit of the underlying stock. The amount of the stock she buys or they buys is based on the delta, a ratio of how much the option price moves relative to a $1 move in the stock. Gamma is the rate of change of the delta of the option. The delta and gamma rise, the market maker, as the delta and gamma rise, the market maker gets more and more nervous. They have to buy more stock to hedge the risk of the option being exercised in the money, i.e., with the underlying price above the strike price. So here we have the simplified makings of the gamma squeeze. As call option purchasing volume suddenly surged thanks to WallStreetBets, Chewey, and Elon Musk, the market makers had to purchase a lot of GME stock to hedge. This set in motion a self-fulfilling prophecy. The market makers rush to purchase GME stock to hedge exposure. This drove the price of GME up. As the price of GME went up, the delta and gamma of GME call options rose. This meant market makers had to buy more stock, further driving up the GME price. Reflexivity. So to summarize, with GME, we had both a short squeeze, number 1, a short squeeze, short sellers frantically buying the stock to cover their shorts, and 2, a gamma squeeze, call option market makers frantically buying the stock to hedge their exposure. Result? This was, I believe, yesterday's close, guys. 147.98. So I'm going to read you guys something more importantly that was written about, I would say, around the same time Mr. Sahil's Bloom's assessment here came out. And this is pretty intense. So it's right over here. I've never seen anything like what's happening with GME before. And I don't think I'll ever see anything like this. By the way, ladies and gentlemen, this is from the WallStreetBets Reddit thread. This is a big moment. a tug of war between tradition and the future. Hedge fund managers live in the past and continue to look down upon retail investors. They truly believe that we, the average retail investors, don't know anything about finance or the market, which may be true, and we're just gambling our money away. We don't know any better. We need hedge fund managers to tell us what to do. Save us. This is the world they want us to live in. This was the past. Remember that scene from Sopranos where Tony's wife calls to buy 5,000 share of Webnonics after she was manipulated emotionally to do so? Institutions and hedge funds want us to be stuck in that world. They're scared of the future. They're scared because so much information is available for free now. There's no more fees for trading. We have large communities that discuss stocks and trading openly. We can think and make decisions for ourselves, which scares the beep out of old school institutions and hedge funds. Beep them all. This affects every single one of you, whether or not you're holding GME. Too long, didn't read. Beep. Hedge funds. This is a crossbow into the future. So, ladies and gentlemen, and people, I hope you guys have enjoyed this little explanation of this tremendous once-in-a-lifetime opportunity to watch this gamma trade. If you're not watching, you're definitely not winning. Make sure you subscribe, like, comment, and turn on those alerts so you're in the know and you're winning along with us and the rest of our private trading club members. God bless. This is Roger signing out.